All right, well, today we are going to be talking about portfolio performance measures, which are used throughout the investment management industry to analyze how good an investor is, what kind of return they're generating relative to the amount of risk they are taking effectively. And before we get into this, I just want to remind you, feel free to subscribe to this channel by hitting the lower right button. This is a great channel to learn basic finance concepts and making finance fun for students, so thank you. So I'm going to go through the calculations here on paper, and then we're going to do an Excel example. So Sharpe ratio. So the Sharpe ratio developed by Bill Sharpe, the excess return of an investment over the risk-free rate adjusted for the amount of risk taken. So there's the calculation there, and here are the symbols. Basically, it's the return of the portfolio minus the risk-free rate, so like a treasury rate in the numerator, divided by the standard deviation of the portfolio return. Now, there are some investors who say, well, the standard deviation isn't a good measure because, sometimes, there's good volatility there. When the standard deviation is a positive return, when you get a real big jump upwards in the return, you shouldn't be punished for that in your calculation. So they've come up with this Sortino ratio, and a lot of hedge funds like to use this number as well. This is the excess return over an investment over the risk-free rate, just like we did before. It's adjusted for the amount of downside risk taken. So it looks very similar, but this time the standard deviation number is going to be the downside volatility of the portfolio return. So we'll show you how we calculate that as we go through this in Excel. Now, another one that's developed was by Jack Treynor a number of years ago. So again, the numerator is going to be the same. It's the excess return of an investment over the risk-free rate. But this time we're going to adjust it for the systematic risk that the portfolio has, which is going to be measured by the portfolio beta. So instead of dividing it by a standard deviation number, we're going to be dividing it by a beta. Okay, so we'll walk you through how we calculate that as well. And And then here are the symbols, just to make sure you have all that down. And then the very next one is the last one. We're going to talk about the information ratio. This is typically when you're looking at the active return of a manager against a benchmark. And so this is the excess return of an investment over its benchmark, adjusted for the amount of active risk or tracking error that is taken. So this, instead of using the risk-free rate here, we're subtracting the portfolio return minus the return of the benchmark. So you can think about an active manager trying to beat the S&P 500. This would be the active returns, the return of the portfolio minus the return of the S&P 500 divided by the tracking error. And we'll walk you through what we mean by the tracking error of that. But it is another standard deviation type of a number, okay? And so, or the active risk, it is often called that as well, as you see down here at the bottom. Okay, so those are the four measures we're going to hit. I'm going to walk you through how we do all this in Excel, and just to keep it easy, I've reproduced those calculations over here on the right. What I've got here is a spreadsheet where I've got the portfolio return is down in this column, and it starts in May of 2014, and we go all the way through the year 2023 and the month of May, okay? And then you can see I've also got the S&P 500 return. It's actually the S&P 400. This is incorrect. This is a mid-cap portfolio. It's run by the students at Suffolk University. Their benchmark is the S&P 400, which is a mid-cap benchmark. And so, you can see when the market goes down, they tend to go down, and when the market goes up, the portfolio tends to go up. So they kind of move together. I've also got on here the 10-year treasury rate, the average 10-year treasury rate that existed in each month over time. That's going to be helpful when we calculate the risk-free rate. And then I've got a few other symbols, and I'll fill those in as we go through this. So first thing, let's go through this. If I just want to calculate the active return or the excess return, how does the student portfolio do relative to the benchmark each month? Well, all I have to do there is just calculate this number minus this number. So I just take the portfolio return minus the S&P 400 return, hit enter there, and then what I can do is just click on that, get to the lower right where my cursor turns into this black X, double click that, and it populates everything. So you can see the students underperformed here by 2.14%, but then the very next month the market was down 427. The students were only down 237, so they outperformed by 1.9%. So that's the excess return or the active return of the portfolio. Now, I'm going to need that when I calculate tracking error later. So all of these numbers over here, I need to calculate these numbers based on this information. I've got everything I need here to calculate all this information. So to calculate the portfolio return, I want the annualized portfolio return since inception. So how am I going to do that? Well, one way to do that is just first calculate how much money would you have if you invested $1 at the beginning and just reinvested that every single month, basically kept it in the portfolio over time. So we'll start with $1. We'll also start with $1 here in the S&P 400. And again, I got to change that to the 400. Okay. And we're going to calculate the value by simply starting with that simple dollar and multiplying it by 1 plus the return. Okay. And I hit enter there, and then I can drag that over and get the same calculation for the S&P 400. And you can see after the first month, I would have earned 1.7 pennies on the S&P 400. So my investment would have grown to 1.01 and change. Okay. Double click that all the way down, and then you can see it grows. Okay. Now, to calculate the portfolio return, okay, a couple things I want to do here. So let's just do annual return. Annual return. Let's go annual return. Okay. Annualized return. I should say annualized return. Okay. Annualized return since inception. So what I would do here is I would calculate that by taking the ending value, and I want to put this in parentheses, take the ending value, dividing it by the beginning value, and I know the beginning value is 1, but I'm just going to go ahead and click on that number anyways. Now that would be the total return since inception. What I want to do is I want to annualize this number. So to annualize it, I raise it to the power of the periodicity, which is 12 months per year, because this is monthly data, and divide it by the number of months. Well, how many months do we have? Well, we know that the data starts in column 3, or in row 3, and it goes down to row 111. So that's actually 111 minus 3, which is 108, plus 1, because I want to include that first month. It's actually 109 months. Okay, so I'm raising it to the power of 12 divided by 109, and I'm subtracting 1 from that number to get a percentage. Okay, so that's how you annualize a return, and I'm going to turn that into a percentage. So the student portfolio has risen 7.76% annualized since inception. The market, as defined by the S&P 400, has actually done a little better. So unfortunately, the portfolio has slightly underperformed. Not dramatically. The market is up 8.22% since inception. Okay, so now I've already got, going up here, I've already got RP, I've got RB. Okay, so those are important numbers. For RF, what we can do for that is, what I typically do is, this is the average treasury rate, but it's an annualized rate. And so what I'm going to do there is I'm going to drag this over a little bit here, and I'm just going to take the average number here. And again, I don't need to annualize this number because it is already, each one of these months, it's an annual yield. So I'm just going to take what the average was over that time period. That's one way you could do it. You could also go through and you could calculate what the historical return of the treasury rate was by kind of using the same method we did here and come up with the monthly return of treasuries and annualizing those the way we did with our portfolio returns and the S&P 400 return. But I think just taking an average interest rate over this time period is pretty standard in the industry. And now we've already got our RF. So we've got the numerator for a lot of these equations. Let's calculate the standard deviation number. Okay, so standard deviation, let's go to the bottom here. I want to calculate the portfolio standard deviation. So let's just put in standard deviation here, okay? And let's do this. All we do for this is we go equal STD EV, and in parentheses we just highlight all of the data. So we go from C11 to C3, okay? And now that is a monthly standard deviation, it's not annualized. So how do I annualize a standard deviation? A lot of people, I ask students this all the time, they all say you multiply it by 12. Well, the reality is the standard deviation is already a number that's square rooted. So you multiply it by the square root of 12. So another way to explain this is if I was going to annualize a variance, the variance is the square of the standard deviation. If I was going to annualize a variance, I multiply that by 12. If I want to annualize a volatility number or a standard deviation number, I multiply that by the square root of 12. Okay? So I've got probably too many decimal points here. I don't need all these, but 16.2% annual volatility. The market has a little higher. So that's one thing the students can point to. They say, well, we have less return, but we're also taking a little bit less risk as defined by standard deviation. Okay, so now I've got the RP, I've got the RF, I've got the standard deviation number. What about this Sortino downside volatility number? So I only want to calculate volatility on down months. So one way I could do that, let me put my cursor there. I'm just going to insert a column, okay? And I'm going to only capture the portfolio return where the volatility was negative. So what I'm going to do is I'm going to put an if statement here, equals if. If my return number is less than 0, then I'm going to say, okay, then give me this number back. But if not, then I'm going to say, give me nothing. And to give me nothing, I hit 2 double quotes there and hit enter. And you can see that first month it gives me nothing. If I double click, you'll see all the negative numbers pop in here. Okay, that's one way to calculate downside risk. So I'm only calculating standard deviation on these numbers here. Because I'm only calculating them on the lower numbers, you can imagine a normal distribution. I've kind of cut off all the high numbers. So I'm really calculating it on a smaller span of data widthwise in a normal distribution. I'm cutting off all the positive numbers. So what that means is the standard deviation that I calculate is actually going to be a lower number now. Okay, and you'll see that. Let me just drag this over here. And you can see it's now 13%. So the Sortino ratio is always going to have a lower denominator because this is just going to be a lower volatility number than that one is. So we're basically saying the good volatility, the good return numbers, I don't need to penalize myself for that. So Sortino ratio, I've got everything I need for that. I don't have a beta yet. So beta basically means how related my portfolio return is to the market. Now we can graph that to get it. So let's check that out. So you could do insert a chart here. So I'm going to insert, let's see, how do I want to do this? I'm going to go insert a chart, and I want to insert a scatter plot like this, and I'm going to select the data. I'm going to add some data here. So for my X values, I want my X values to be the market return numbers. I want them to be this column D. So I'm going to highlight column D here. My Y values, I want them to be my portfolio return. So I'm going to highlight those. Okay, so it's C3 to C111 and D3 to D111. I'm going to hit OK. I'm just going to hit OK. I'm not going to label anything. If I wanted to, I could label it. But basically, this is the S&P 400. These are all the months how the S&P 400 did, and these are all the months how my portfolio did, or the student portfolio did. So you can see in this month, the S&P 400 was up about 11%, I'd say, and the student portfolio was up, 7.18% that month. And so this kind of just shows you how related the returns are to the market. And to get the beta, well, one way you could do it is you could click on the dots here like that. And I clicked it with my right cursor, and then I get this add trend line. So the trend line fits a line in there, the line of best fit. And then I can actually tell it to display the equation of that line on the chart. Okay, and hit enter. And let's see, do I got that? Yes. And you can see it here. I don't know if you can see this. It's very small lettering. But it says 0.8462x. So this is the equation of a straight line. It says the portfolio return is equal to 0.8462 of the market return plus this constant. 0.8462, that's my slope. That's my slope. That's my beta. When the market goes up 1%, my portfolio tends to go up 84 basis points, 0.8462. Another way you can get that number, so I'm showing you a couple of ways. Let me show you a different way. If you don't want to go through the hassle of graphing it, you can just do this. You can hit equals slope. And I can go slope. I can highlight all of this data here. Portfolio return, put a comma in here. And now I highlight the market return. So it's just calculating that same number. I'm going to close that off, hit enter, and boom, look at that. It gives me the same number, 0.8462. Okay, so I showed you a couple different ways, but that is the beta now. So now I've got this number. I've got beta. The only thing I don't have is this sigma A, and that is the tracking error. The tracking error is the standard deviation of my active return. I calculated my active return a little bit ago. That's just the difference between the portfolio return and the market return. So now all I have to do is calculate the tracking error, and that's generally going to be a smaller number than the overall standard deviation is. So what I'm going to do is I'm just going to hit Control C, and I'm going to put my cursor there and hit Control V, because again, that's referencing everything above it. It's the standard deviation of this series annualized. So my tracking error is 6.03%. Okay, that's a very active portfolio. When you go into the investment management industry, tracking errors north of 4-5% are pretty active portfolios. An index manager has a tracking error very, very close to zero. And so, that gives you some idea. The active risk is how much risk am I taking relative to the market. If I'm not taking any relative to the market, then I'm an indexer and I'm matching the market. Well, here I'm taking some risk. I've got everything I need now to calculate my stuff. So I'm going to get rid of this chart because it's in the way of my calculations. And let's go ahead and calculate some stuff here. So let's do this, the Sharpe ratio. The Sharpe ratio is just going to equal the return of the portfolio minus the risk-free rate. Okay, so that's going to be return of the portfolio. That's this number down here, minus the risk-free rate, which is the 10-year Treasury rate. Okay, we're going to close that off. Got to make sure you do the parentheses right or you'll mess everything up. And then I want to divide it by the standard deviation of my portfolio return. Okay, so it's a positive number, and it's really hard to interpret the Sharpe ratio. What does that mean, 0.34? It just means, it's just a number, to be honest with you. And you want it to be higher. You want it to be positive and you want it to be high. And you want to compare it to other funds. How much excess return am I getting for a unit of risk? Okay, the Sortino ratio is the same calculation, except I use a different standard deviation number. So again, I'm going to use that same, I'm going to go down here, go to the bottom, and use my same 7.76 return. I'm going to subtract out, I messed that up. I'm going to subtract out the risk-free rate, which is 2.18%, and I'm now going to divide it by the standard deviation of the downside. Okay, that was that number right there. I don't think I did everything right there. So let's go back up here again. Sorry, I'm messing this up a little bit, but we'll get there. I'm going to divide that again by this number down here. Okay. Now, that should be a higher number, right? Because I'm using a smaller denominator. And I don't need it in percentage terms. Typically, this is not expressed in percentage terms. It's expressed, let me put general. It's expressed in just regular number format. Okay, again, higher is better. Treynor ratio is going to be the same numerator, but now we're going to divide it by the beta of the portfolio. Okay, so how much excess return am I getting per unit per beta risk? So again, so we go equals, and again in parentheses, return of the portfolio, all right, minus the beta of the portfolio, which is 0.8462. Excuse me, nope, I did that wrong. 10-year Treasury again. Now I'm going to divide that by the systematic risk of the portfolio, 0.8462. And again, I didn't do that right. I'm just going to look at that. It's C116. So C116, I'm going to go up here and just type that in. Divide it by C116. Okay, and this is also doesn't need to be expressed in percentages. So we're going to put this in general terms. Divided by C116. Okay. So for every unit of beta, well, I could do that. I get I get 6.6% in return. I do like expressing the Treynor ratio in percentages. So basically, I get an additional 6.6% return over the market every time I have a beta of at least 1. That's kind of what it's saying there. Okay. It's the excess return I get over the risk-free rate per unit of beta. The information ratio, now a lot of this is done. A lot of people look at the information ratio in the active management world. They want to see how a manager is doing relative to the market. First thing is it should be positive. It's not going to be positive in our case because our return of our portfolio is less than the benchmark. So let's check that out. Let's do this down here. It is 7.76%, but it's minus 8.22. Which isn't too bad, because we are taking a lot less risk in this portfolio. So, we'll interpret these at the end here. Now I want to divide this by the standard deviation of the active risk number here. That's the 6.03 number. So I'm going to divide it by this number here, and I'm going to hit enter. Okay. And that is my information ratio. This is typically expressed not in percentage terms either. It's just expressed a lot like the Sharpe ratio and the Sortino ratio is. And so it's IR is minus 0.07. It's a very small number. For every unit of active risk I take, for every 1% in active risk, I lose 7.5 basis points in excess return, which isn't too bad. The way I would interpret this is, hey, we've got a Sharpe ratio of 0.34. I'd want to see other money managers, how their Sharpe ratios are. One thing is our return may not have been as strong, but our volatility is low. The portfolio volatility here is lower than the market. So I would imagine a lot of other managers will have high portfolio numbers. And so they might be giving you good returns, but that might be coming at the expense of taking additional risk. All right. Another thing is our Sortino ratio looks pretty promising there, even better. And again, because our downside risk isn't all that great. Our Treynor ratio is fine. We've got, our beta is low, so that's probably boosting that overall ratio. The only place we're hurting is we are still underperforming the benchmark. We're hoping to correct that in the coming year with some better stock selection, but it is what it is at this point. But those are the 4 major ratios that people calculate. In the industry, there are other measures that people look like at Jensen's Alpha, and I have addressed those in other videos. So check those out as well. But hopefully you enjoyed this movie. If you liked it, give it a thumbs up. Please subscribe to the channel because this is a great place to learn finance because this is where I make finance fun for students. Thank you.